Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Right, so stocks got whacked yesterday. Powell's testimony at Congress turned out to be a hawkish event, and he opened the door to higher terminal rates and to potentially 50 basis point hike in March if the data required it. That was the exact words. Commodities were also hit hard with nearly 2 sigma moves across the complex, except for nat gas, which obviously had its big move the other day, down 12%. So that managed to finish in the green, but all the other commodities getting hit very hard. Vols also bounced, not as much as you might expect. So if you look at US index vol, up half a vol to a vol, which isn't really, given the kind of ferocity of the move down, or how it felt at least, that's not that big a move. So fixed strike vols were quite muted. We'll go into a bit more detail there in a bit. But if you look at the sigma move, it was only 1.3 in terms of S&P, and then NASDAQ, Russell, etc., not even one standard deviation move compared to what their implied vols are. So not necessarily a big need to panic there. And that can explain why maybe implied vols didn't ratchet up quite so much. Commodity vols did bounce. So you see GDX, silver, oil, all having a nice bounce there. Uranium vols were higher as well. But nat gas vols did ease back some because that obviously didn't move as much. They were down 2 vols. Carry-wise, still got positive carry in US, negative carry in Europe and China, and FTSE's got the most, or actually is in line with Russell here at around 35% in terms of positive carry. All that precious metals carry has gone away pretty much, looking pretty neutral there after those huge drops. We saw a 2.6 sigma move in silver, 2.1 sigma move in gold. Those type of moves are going to evaporate a bit of positive carry. Although if you look at implied vols, we didn't see a material uptick in implied vol in gold. Gold vol is actually unchanged and still on a 13 handle. Realized now back to 13.5. I find that quite interesting given that gold moved so much and the vol didn't. If you are looking to pick up calls in gold, given these implied vol levels, it doesn't look like the worst time in the world. And then skew-wise, we saw a bounce in skew, not massive, but a little bit of bounce in skew, and that was just because as you ride down to a lower part of the vol surface, that the fact that the vol surface is a bit more asymmetric, you end up moving to a place where skew is a bit steeper, and that's really what we saw there. Nikkei downside still offered, still looking very low, pretty much on its lows. So for those who think the Nikkei is looking toppy here and the Bank of Japan might do something on Friday, you might want to pick some puts up there. And then on the commodity side, silver standing out as the most expensive skew in terms of where it historically trades. Clearly, there are other assets with a higher actual absolute levels of skew, but just in terms of silver normally trades for calls, right now it's 3/4 of a vol for puts. And we think selling silver puts into this weakness for those who don't own silver and want to own it at lower levels looks pretty good. Okay, that's the vol summary. Okay, so let's talk a bit more about this, what Powell did. So the way I see it is Powell bought optionality for bigger hikes, right? So the timing of the testimony in front of Congress, we're about a week before the Fed goes into blackout. So they go into blackout on the 11th of March. And that period between the 11th of March to the 23rd of March, which is their blackout period, contains the US CPI date release, right? So, and as CPI has been as inflation has been reaccelerating, that is a big number, right? It's a big deal. So the hawkish tone that he gave in his testimony that has triggered a repricing in the rates market has taken the chances of a 50 basis point hike up to 70%. So it's actually now priced more likely that they're going to hike 50 than hike 25, which is quite a dramatic move over the last month, where a 50 bip hike was maybe a 10% or less probability. That has gone that way. So the current one is the dark blue. So it's gone from very low probability to 70%. And basically, if we look at what the 25 probability is, dropped like that, basically. So that's the moves that we've seen over the course of the last month. So one thing is for sure is that at least now the market won't be shocked if they hike 50. So that's what I mean by he's bought optionality, because what he's basically, if he does hike 50 because the data warrants it, then it's not like the market needs to be completely shocked and crash on that, because now he's kind of opened the door to that. So that's what I mean by him buying optionality. Not that he's going in there and buying a load of options PA, basically, right? That's not what I mean. Terminal rates obviously pushed up to through 5.6. 2-year yields went through 5, but the 10-year yield fails to go through 4% again, where it was last week. That's taken the curve inversion into an extreme of 40 years again, minus 107 basis point on 2s 10s. Now, what have the rates markets done? They've essentially pushed out the pivot past the end of this year. But if you look at the spread between euro-dollar futures in December 23 and December 24, they're still at minus 146 basis points. So the rates market, whilst agrees that we may go higher in terms of this rate cycle, and we're not going to turn as soon as we thought because recession might be delayed, when we do turn, we are still expecting 150 basis points of hikes, pretty sharpish within the year. Okay, so that within a year from when we start to turn, that's what the rates market is pricing, and that is counter to this higher for longer narrative that the Fed speakers keep pushing. So something's not quite, again, the rates market's not quite buying into exactly what they're saying right now. And then lastly, we do think the bar now is set quite high for non-farms or the CPI data to surprise to the hawkish side in response. So we do think response to weaker data in either of these prints is going to be stronger in terms of the market than the response to continued high and hot prints. Okay, so we've already seen a run of hot prints, and the market has kind of digested it, and the market is primed for higher rates now. So we think the reaction to the market is going to be a much more violent one should the data come in weak, and then we can rip to the upside and rates can pull back, because my God, they've come a long way in the last month. Okay, moving on to fixed strike vol. So we mentioned that fixed strike vol hasn't really done what you might have expected on that drop. We had a 1.5% drop in the S&P in a day, reasonable size drop. What did fixed strike vol do? So March volatility, now that's only 10 days away. So that's not really true vol, but it did spike a little bit. It was up about 30 to 40 basis points in the local strikes. But if we look at April vol and June vol, which is a bit more meaningful, very small moves, right? We're talking about not even 10 basis points in these downside strikes. The deep downside was actually offered. You look at June downside, anything below 39.50 was down 20 basis points. And anything above was also down. So fixed strike volatility, and you can see that in all these little reds down here and the reds here, fixed strike volatility is actually getting softer as the market's coming down, right? And that is basically saying that the street is not reaching for vol. It's not like there's a load of clients that are coming in and adding protection and buying puts and getting spooked by what Powell said. It's just saying people are prepared for this. They're ready for this. The street is not in an uncomfortable position anymore. You remember how a few weeks back we said we thought the street was getting more uncomfortable because skew levels were going crazy bid, which was a sign that dealers were getting taken short downside because clients had bought protection. Well, that all started to reverse last week. We saw skew come down. We saw implied vols come down. And that was the street getting given back that protection. And that was it. That left them in a place of comfort. And that allowed the market to kind of rally and not be so fragile to the downside, basically. And we kind of think this move down, because we didn't see any of that bid come back to fixed strike vol. Again, we don't think the street's in that uncomfortable position. And therefore, this put wall that we have with spot gamma, this 3,900 area, we think that's probably quite likely to be a strong support area where we're probably going to need a lot to really break through that level, we think, to the downside. So that makes us feel like that's a strong support level that the market is very likely to hold on to. And we do think that the risk of more shocking moves are probably going to be to the upside if we were to get weak data out of these two big prints that are coming up in the next week. Okay, now if we have a look at crypto, something I don't talk about too much in the macro daily. Obviously, our weekly crypto subscribers will know what we're thinking there. But in general, just wanted to flag here that crypto markets are really decoupling from macro in quite a big way. So if we look here, we've got the correlation between the SPY ETF and the BITO ETF, which is your Bitcoin ETF, right? Futures-based one. And we're just comparing the 30-day rolling correlation going back the last year. And we can see that early last year, it got as high, it got into the 80s. In general, if we say it was kind of around the 60 to 70 area for quite some time, oscillating around that for most of last year. And look where it is now. It's absolutely collapsed to the point where it's at around 20-25%, that correlation. So Bitcoin really moving to its own beat, not really caring what the S&P is doing. And that tends to be a good thing for crypto markets, right? If they can decorrelate, because it makes them actually an asset that adds some diversification to a portfolio. So that might be one reason to like it. But just in general, the fact that it's decorrelating is an interesting statistic and something to be aware of. Now, what about the actual price action? The price action has been pretty good, right? So it's been carving out a bit of a bottom. 21K looks like quite a strong support. It had a really impulsive move higher in January. It's been correcting that move, and we've got buy calls screening across the cryptos, some of the crypto stocks, and this BITO ETF, right? So spot is quite low in its range. Volatility is quite low in its range. So buying calls looks quite interesting. Okay. So generally that's the idea. Like, opportunities pop up in crypto when spot looks quite overstretched to the downside and vol is actually quite depressed. Buying calls looks quite interesting. Okay. And we do think that if the Fed hikes don't come in as aggressive as the market has repriced to, then we do think risk assets can rally, and we think crypto is likely to participate in such a rally, especially if the dollar can pull back a bit. So then, looking at the Vol dashboard, we've already said buying calls is screening on the strategy compass, but you should always check to see what's the Vol carry. Vol carry is positive, so it's closer to earn than to pay. So we need to be a little bit more conscious of just buying a load of calls when Vol carry is still quite positive, because that's suggesting that these implied Vol levels are materially higher than realized Vol right now. But realized Vol, to be fair, is at the low end of the range in the 30s and can easily pop as well if we were to get a pop in spot. So you may just want to buy outright calls, but if you're a bit more sophisticated in the way you like to trade options. All right, that's it for today. Thanks a lot for listening, and I'll check you guys out tomorrow. Thanks.